Not optimizing your credit score when you go to buy a home can literally cost you hundreds of thousands of dollars over a 30-year period just on the difference in interest rate alone. In this video, I'm going to share the 3 tips that I use with my clients to help them optimize their credit score to make sure that they get the best deal on the mortgage rate when they go to buy a home. My name is Xavier Williams. I'm a realtor and mortgage broker based out of San Jose, California. I specialize in helping the middle class achieve home ownership as well as build wealth through many tips and strategies that I've learned over the years. This is a brand new channel and I'm coming over from Instagram where I share different tips and strategies my clients have used to buy and sell real estate and has helped me amass over 22,000 followers as of today. So if you're looking for personal finance tips, real estate, and mortgage tips, hit the subscribe button and please like this video to help my channel grow. I look forward to sharing so much more content with you guys. Now, before we get started, what's a credit score? Your credit score is a numerical representation of the amount of risk that you pose as a borrower to any specific lender. The credit bureaus, and there's 3 different credit bureaus. We have Experian, TransUnion, and Equifax. Each one has their own algorithm that determines what your credit score is based on a variety of factors. The 5 factors that are used to generate your credit score is number 1, payment history. Number 2, the amount owed on your credit accounts. Number 3, the length of your credit history. Number 4, the mix of different credit accounts that you have on your credit report. And the 5th is the amount of credit inquiries that you have based on the applications you made when you apply for credit. Each one of these components is weighed differently based on the credit bureaus. So for example, on Experian, your payment history makes up 35% of your credit score. The amount that you owe on your credit accounts makes up 30% of your credit score. The length of your credit history makes up 15% of your credit score. And the amount of inquiries you have makes up the other 10% of your total credit score. Tip number 1 is optimize when you make your payments. The first tip is actually the easiest one, and it's gonna fall under bucket number 2, amount of balances on your credit accounts. You see, when we run somebody's credit to do a pre-approval, very often clients are like, hey, I already paid off those accounts. I'm not sure why they're showing a balance. Here's why they show a balance on your credit report, even though you paid off the balance on that credit card. When you apply for credit, for example, when you're applying for a mortgage, we pull your credit report, which is a snapshot of your credit history at the time that your credit is ran. The reason why that's important, most credit accounts only update your credit report once every 30 to 45 days. So depending on when your payment was made, your latest credit report might not reflect the actual balance that you have today. For example, if you paid off your balance on November 1st and we run your credit on November 15th and your credit card company doesn't report the payment to the credit bureaus until November 21st, when we run your credit, it's going to show your balance from the last time your balance was reported to the credit bureaus the previous month of October, which would have been October 21st last month. So we want to make sure that the balances that are being reported on our credit report happen right after you make your payment. Now the question is, how do you do that? We have no control of when a credit card company reports your balance to the credit bureaus, but there is one thing we do have control over. You see, most people make the payment on or before their due date, and that's actually what's getting you in trouble. So before you implement this tip, first I recommend you set up your credit card account on auto pay for the minimum amount. That way, if you make a mistake following this tip, you won't have to worry about missing a payment because your payment will always come out of your account for at least the minimum amount, which will protect your credit in case you forget or you make a payment at the wrong time. What we're gonna wanna do is look for what's called the statement date on your credit card account. While we can't control when your credit card balance is reported, the balance that your credit card company reports is going to be the balance on your most recent credit card statement. What that means is we want our balance on our credit cards to be at $0. We want to make whatever payment we were planning for, and ideally you'd want that to be a 0 balance. But if it's not, if you're only making a partial payment, you want that payment to hit before your next credit card statement comes out. And you don't want to run any additional charges until your next statement comes out. That way, your credit report reflects that you're paying down your debt in full or making progress towards paying off your debt in full, which you also get credit for, whether you completely pay every month or whether you're paying off over time. What the algorithm is looking for is the trend of your balances over time plus your actual balance on the day of the credit inquiry. So by zeroing out your balance before your next statement comes out. When the creditor goes to report your balance to the credit bureaus, it's going to reflect a zero balance because when the statement came out, your balance was zero. You're now getting credit for the next 30 to 45 days until your next statement is reported for having made that payment. If you were to make your payment on your due date, your next statement comes out a few weeks usually after your due date. So you make your payment, you spend on your card, well now your balance is going up and you've lost pretty much the credit of making that payment. So this is how you optimize your score. It can increase your score by up to 30%. Tip number 2, use a method called AZEO. The AZEO method is going to hit bucket number 2 of your credit card balances. Having at least 3 credit cards, 2 with a 0 balance and 1 with 9% balance of its credit limit is going to give you the highest boost in your credit score. Now, what does that mean? It means you got to use tip number 1 to make sure 2 of your credit cards have a 0 balance when your next statement comes out. The third credit card, let's say for example, it has a limit of $1,000. Well, what you would do is you take your $1,000, you multiply it by 9%, and that would give you a 9% balance that you want to shoot for of $90. That $90 is 9% of your total overall credit limit on that card. That's going to help maximize your score as much as 100 to 150 points. Tip number 3 is going to fall under the bucket of credit mix. What we're going to want to do is optimize your mix of credit accounts, okay? Now, there's a big misconception that you need to be in debt to build credit, and that's not true. What you want to do is have those 3 credit cards and at least 1 installment account. What is an installment account? An installment account is a fixed term loan. Think auto loan, think personal loans, think student loans, think mortgage loans. Those are installment. The amount that you're borrowing is fixed, say $100,000 over 10 years. By the end of those 10 years, that entire balance is cleared out. A credit card is considered a revolving account. You can charge it up to its limit. As you're paying it off, the amount of credit becomes available. That's what revolving is. You use it, you pay it, your available credit revolves back to being the difference in your payment. You only need 1 installment account, and you don't have to go out and buy a car. You don't have to go out and take student loans out, and you don't have to go out and take a mortgage just to optimize your credit score. You can walk in to your local credit union, take out something called a secured installment loan. The way it works is you can deposit $200, $300 into a savings account with the credit union, and they'll give you a loan for the same amount. Now, why would you want to go this route? Well, A, the interest rates are much lower because you're securing the loan with your own savings funds. And 2, once that loan is paid off, your funds get released. It's basically like a savings account that allows you to build your credit with your own money. The third tip is going to fall into bucket number 1, payment history. There's not much you can do regarding your past payment history. Obviously, you want to continue to make your payments on your accounts on time so that you don't get a late payment on your credit report. 1 late payment can immediately drop your credit score by over 100 points. And the only way for your score to rebound from that late payment is to make consecutive on-time payments over the next few years. Your score will not recover from a late payment for at least the first year. And usually that late payment stops hurting your credit score at least 2+ years out. So if you have any late payments, there is one way that's legal that might be able to help you out in terms of reversing those late payments on your credit report. What you're going to want to do is reach out to the creditor and ask for a goodwill adjustment. Let them know that, hey, you've been late in the past and you're looking to buy a home down the road, and you want to see if they'd be open to removing that late payment from your credit report as a one-time courtesy. It doesn't always work, but it has worked in about 60% of the cases for my clients. Now, you're going to want to look for either the executive offices at the creditor or their headquarters. You can type up a letter. There's plenty of templates. If you go to my website, xavierwilliams.com, I have a section where you can go and grab a template of this letter where you just fill in your account information and the address for the creditor and send this letter out and hope that it gets removed. Now, if you have collection accounts, which is a negative type of account that shows on your credit history, one of your previous accounts wasn't paid off in full, or it was charged off because you stopped making payments and the creditor sold off their debt to a collection company to come after you to get those funds. Number 1, never pay off a collection account before doing this one thing. A lot of people make the mistake of thinking that once they pay off their collection account, it's going to help them boost their credit score. Now, depending on the credit score that the credit bureau is using, a majority of them actually do not give you any positive boost in your credit score if you just simply pay off the collection account. What you want to do is negotiate something called a pay for deletion. What a pay for deletion is an offering compromise to the collection company saying that you'll pay off the balance that's owed in exchange for the collection company deleting that account from your credit report. Once that collection account is removed from your credit report, that's going to immediately boost your score as much as 100+ points if it's the only collection account in your credit report. Now, when you're negotiating for this pay for deletion, you want to make sure you get the offer from the collection company in writing stating that they're going to go ahead and delete that account once the payment is made. Now, sometimes they won't negotiate on the balance in exchange for the deletion, and sometimes they will. So always shoot for trying to negotiate the balance down in that exchange for the deletion. Tip number 4, don't run your credit. This falls under bucket number 5, credit inquiries. Every time you run your credit score is taking a hit. There are 2 exceptions, which I'll cover in a few minutes. The reason why creditors care about inquiries is it gives off the vibes that you're desperate for credit because you're in financial trouble. The characteristic of high credit score people is they typically don't run their credit much, if at all, for a number of years. So what you want to do is not run your credit unless you absolutely need to, especially while you're working on building up your credit. Now, if you're applying for a mortgage, or auto loan, free to run your credit as many times as you need to within a 2 period, 14 days. Why is this important? The credit bureaus understand that different lenders are going to offer you different rates. And so obviously a borrower is going to want to shop for the lowest rate that they can get based on their credit score. Now, say you're shopping for a mortgage and you run your credit 10 times. Well, instead of your credit score being hit for 10 different inquiries, applications for a mortgage or auto loan, your credit report will show all 10 different inquiries, but it'll only affect your credit score as if you only ran your credit once. So if you hear a mortgage officer or a dealership saying, don't run your credit, they likely want to make sure that you're not going to go find a better deal with someone else. So feel free to shop around. I encourage all my clients, whether they're using me or not for a mortgage, to shop around so that they feel comfortable with the mortgage and the rate that they end up selecting. If you found any value in the content of this video, make sure to hit the subscribe button and like this post. And feel free to drop me a comment. I read and respond to comments as they come in. It would greatly help me to grow this channel and be able to provide even more knowledge and tips that'll help you save thousands of dollars in the long run. Now let's keep going. The 5th and last tip has to do with the credit mix and the number of credit cards I recommended. So if you need to get 3 credit cards, but you can't get approved for any credit cards, there's 2 easy ways around this. You can ask a family member or even a friend to add you to one of their credit cards, not as a joint owner, but as an authorized user gets a copy of the credit card, but they don't have to give it to you. They can keep the credit card and simply have you as the authorized user. The benefit of that is they don't run your credit, and every time the actual account holder makes a payment, that payment also goes on your credit report as if you own the credit account. Now, you're going to need at least 1 credit card because certain mortgage lenders will not include authorized user accounts depending on the rest of your credit report. So the easiest way to go about getting a credit account without having to run your credit is to open up what's called a secured credit card, similar to the secured installment loan that I spoke about earlier. Secured credit card is the same concept. You drop, say, $500. The credit card company will give you a credit card with a $500 credit limit every time you make your payment, and it works the same as any credit card. So the only difference is the bank is holding that $500 in a savings account in case you decide not to finish paying off the credit card. Well, they have collateral to pay off the charges that you ran up. Now, there's a few fintech creditors who have secure-like credit accounts that report to your credit report the same as a secure credit card without actually having to put up a security deposit. In the description of this video, I posted a couple of those creditors that either I or my clients personally have used to establish or build their credit. I hope you found that video useful. Feel free to drop a comment. Make sure to subscribe and hit that like button, and I'll see you guys on the next one.